my forecast is the national unemployment rate continuing to drift down this year from 4.1% today to something like 3.7% late this year, and to stay around 4% or a little bit below over the next couple of years. Again, if you go back and for our lifetimes, an economy that's that strong, with an unemployment rate under 4% for a significant period of time, you really have to look back at the late 90s, around 2000, or quite honestly go back to the 1960s. Now, as soon as I mention the 1960s and very low unemployment rate and all that, a natural question comes up, well, that didn't end well, because the 60s was followed by something called the 70s. And that was a period that was defined by stagflation, two words that we do not want to be associated with the U.S. economy, stagnation and inflation. So obviously that's part of our kind of challenge in managing the U.S. economy through monetary policy, is to keep the economy growing, like on this, good solid growth going forward, good job growth, keep the economy strong, at the same time as not allow imbalances to form in the economy, especially that might lead to inflation or other problems. And so that's the fine balancing act that we're facing at the Federal Reserve in terms of policy. The good news is inflation's really low. Inflation in the US is about 1.5% overall for the last year. The Fed has set a target of 2% inflation, what we want over the longer term. So we have a little bit of room to allow inflation to drift up over the next couple of years. And my forecast is, with a strong economy, and some of these special factors have been holding inflation down the last couple of years ebbing, I expect inflation to move back to 2% over the next 2 years. So, from a point of view of the Fed's goals of keeping the maximum employment and price stability, these are our two overriding goals for monetary policy. I think we're in a very well situated now, very low unemployment, good solid growth in terms of the economy, and with inflation a little bit low, but moving back to our 2% longer run goal in the next year or two. So this is a very good situation to be in. What we need to do is keep us in this situation, and that means getting monetary policy back to what we would call normal. Currently, short-term interest rates are a little bit about 1.4%. That's for the bankers in the audience, that's a lot higher than that 0.1% that we had for about 7 or 8 years. But we're gradually trying to get monetary policy back to a more kind of neutral setting in order to keep this economy, I think, like I said, in this fine balance. We wanted to continue the expansion to continue. We're in the third longest expansion of history for the U.S., going back to the Civil War. We'll soon, in the next few months, be to the second longest economic expansion in history. And I would think a good goal for us is to try to get to the longest expansion, which was the 90s expansion.